This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au to book an appointment.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day. Hey, guys. Phil Tarrant here, host of the Smart Property Investment Show. I hope you're well. I don't know if you tune into it. I know many of you are sort of locked in at the moment and trying to understand what the RBA is doing, where the economy is heading, what it all means for property investors. Had a really good chat with Mark Burris the other day. It's released out on this podcast network, the Property Investment Podcast Network. It's quite a long podcast. We went for about 50 minutes, nearly an hour, chatting all things through what's going on, his view of property markets, the economy, interest rates, and that's something that's been around for quite some time in many different markets. I highly encourage you to go and tune into it. Some really good, sage discussion around all those factors and what you should be doing or can be doing as an investor. I think his view by memory was he reckons we've topped out on interest rates. Only this morning I was reading 70% of sort of economist survey reckon there's going to be a pause in interest rate increases in April. Back to the chat I had with Mark, he said, Stephen Koukoulas, who's an economist, he reckons one more 25 basis points to come. So, the catch all of that is that we're nearing a terminal rate. Whether we're there yet or not, I can't make that call. You're only going to know that we're there when we actually get there in hindsight. But there's other people coming out, AMP economists, for example, saying there will be consecutive rate cuts next year. So this is the balance of the economy right now, to balance the RBA in trying to get a hold to wrangle inflationary pressures without damaging the inherent health of the economy. Only this week or last week, we've seen the collapse of a US-based Silicon Valley bank, to give some sense for some of the challenges in capital allocation when it comes to these financial institutions and some of the inside of mortgages. It's a big deal. I think the US Federal Reserve or the US government's come out saying it'll back all those deposits inside of that for all of their investors. And that's good news, but it gives some sense to the fragility of the financial markets at the moment, as it also tries to contend with these inflationary pressures. For Australia, the news is good. Our inherent strength in our banks is a good one. So that's a big tick. And also the actions and behaviours and the policies and regulation submitted by the prudential regulator, APRA. Again, frustrating for many property investors because they've maintained the fact that they're going to keep this 3% buffer on the serviceability of all Australians, which is hampering some people's ability to borrow money. The inverse of that is largely the inherent strength of our major banks. So a lot of things to try and balance out. So go and listen to that chat, but get informed, get educated about what's going on in financial markets at the moment. The catch-all is that, yes, there has been a lot of interest rates kickstarting in May of last year, and nearly a year into this upwards rate cycle. We're getting towards the end of it. So you can start thinking about acting and operating with a little bit more continuity in how things are going to pan out. So you can start doing your numbers based on where we are today and how you're going to capitalize that into the future. Now, for a lot of Australians, they're tapped out when it comes to investing in resi property outside of their superannuation for many reasons we spoke about at length on this podcast around serviceability thresholds. So they might have a deposit, but they might not be able to borrow because the banks have said that they don't meet the serviceability requirements. So therefore, they're shuffling their debt, trying to release some equity, maybe selling down some assets, maybe paying off some stuff to get ahead. It's a fine balance. And we've been chatting about this at length with our friends over at Finny Mortgages, finny.com.au, about some of the scenarios and case studies they're saying in their business and sharing them on this show. If you are struggling with serviceability outside or investing in property, maybe you can start considering how you can expand your investor footprint or threshold by operating inside of a self-managed super fund. Now, self-managed super funds aren't for everyone. I'm a journalist. I'm not in the business of giving financial advice, and nothing in this particular podcast constitutes that. My recommendation would be that you speak effectively to a very good accountant around structuring that sort of stuff and all the requirements of operating inside of a self-managed super fund. I have a self-managed super fund. It works pretty well for me. I hold both property and shares inside of it. And it's something that I'll look to grow over time in a considered way. But for many Australians, it might be time to look at SMSF investing and borrowing inside of your SMSF. Joining me in the studio, backed by popular demand, has become a hugely popular part of the Smart Property Investment Show. Eva Loanzons from Finny Mortgages, finny.com.au, senior broker there, and also one of the most considered voices in mortgages today. Eva, how you going?
Hey, how are you? Good. I'm great. I'm happy to be back again and share a bit more about lending and SMSF today.
Yeah, and we're getting heaps of feedback in from our discussion. So thanks, Eva, for supporting the Smart Property Investment Show through this. We get people writing in going, I love these case studies. Can you do something on this, that, and the other? So we spoke last time that we'd look at SMSF, and I think the time is right for this. To my point about my long-winded introduction, Eva, this might be the only way that property investors can continue to grow, accumulate property in this market is doing inside of self-managed super fund, because it's largely isolated from other stuff. So it's very appropriate that we have this discussion point now, because it might be like this for the next period of time before we get to a reducing rate environment rather than rising rate environment. But I hear, though, that you need more mortgage brokers. The team, you've grown a team at Finny. Is that true? Or is that just a rumor?
No, that's a true one. We're getting so busy that we are looking to expand and get a few more brokers. So if someone is listening and have been broking for quite a few years, are investors themselves and looking to change career and come and join us, maybe they should get in touch.
Okay. Well, how do they do that? Just via the website or give you a phone call?
Or they could email the resume at info@finny.com.au, and that would get to me and I can have a look at it and get in touch.
Cool. All right. So you're looking for experienced brokers who are property investors?
Yes.
Okay. And they know about SMSF probably.
They need to be both investors and brokers. Yeah.
Well, I know you and your team, is hand selected because of the work that you're doing primarily within the investor market. But that said, also for all those people with owner-occupier mortgages, this podcast is not just about investing in property. Your owner-occupied home is also a property investment, and it's probably where you need to be most strategic about your interest rates and the mortgage that you have connected to it, and then also how that is a source of utility for supporting property investment. Most people start off investing in property because they've created good equity inside of their principal place of residence with a smart approach to the debt. So I always say to property investors, get your principal place of residence sorted out first in terms of its mortgage and get that structured right with a mortgage broker that knows what they're doing with an eye towards property investment in the future. So that's key. And I know the guys over at Finny Mortgages, they would chat to you about your principal place of residence and mortgage attached with it as well. But Eva, SMSF. So I've got an SMSF. A lot of people are daunted by SMSF. They think they're quite hard to manage and maintain. What the headline is a bit of a hassle to set up and to create all the banking around it and all the infrastructure stuff. A really good accountant should be able to sort all that out. Now, SMSFs hold more assets than retail industry funds combined. So it's a huge area. I think there's 2+ million trustees now, well over 1 million SMSFs in Australia. So it is a very popular investment vehicle for Australians. And once upon a time, a lot of people bought property in SMSFs. Then it got pretty hard because lenders that serviced mortgages inside of SMSFs really scaled back. This was sort of 5-ish sort of years ago, and those that remained jacked up the rates really high. And then there was a bit of a resurgence back into the proliferation of lenders servicing the SMSF market. Rates come back down, and that's pretty much where we operate today. So people buy both commercial and resi stuff inside of their self-managed super fund. But you've got a great case study for us today, Eva, around how one of your clients who I've sort of read through it really quickly. They're pretty representative of people that operate inside or buy inside of their SMSFs. Tell us about the client. Again, like we're using first names, not using last names. It's completely unidentifiable. We've spoken to the particular client, and you've said that they're happy to talk in general about what they're doing. Tell us about this family.
Yeah, so family, married couple, they are in their early 50s. They've got 2 teens at home. They bought, like many people do, they owner-occupier property. There is a big loan on that property. And I think it was roughly 10 years ago, they bought one investment property, and that's where they're at. They came to me saying, we'd love to buy a second property, but we know we maxed out completely. We know we can't do it, but we'd like to find a way around it because that's where we believe the growth is and our wealth will be in the future. So they were keen to look at any alternative to get going.
So do they currently have a self-managed super fund, or they set it up specifically for this purpose?
No, they didn't even really know, I think, about SMSF before we started the conversation. So it was all new to them. And it was specifically set up, I guess, after we spoke and after I mentioned the idea to them. Obviously, they needed to meet with the accountant, financial planner to see if it was for them, because it's not as easy as just going and buying a property. So, yeah, they didn't really know about that before we met. It was we met actually to set up a plan for them to be able to buy another property. So that's also something people should do. If they are maxed out, they should still meet with their broker to work out a plan that would allow them in the future to actually buy another property, whether it's to reshuffle their debts, to find a solution to reduce unsecured debt, to see maybe if the kids are close to 18, which then they wouldn't be dependent anymore in the next few years, just like this couple. So we actually did a workout a plan first on what they could do in the next few years outside of super. And I also mentioned the idea of an SMSF that could work for them right now. And that's what we started with.
So they've got a principal place of residence and one investment property. So why do they want to keep investing in property?
Just wealth creation. They are in their 50s. They don't really see themselves working for another 15 years. And they just wanted to, I think, have a positively geared property that would help them pay their home quicker, so then they could retire quicker. That was the main focus, I guess. Mm. Yeah.
And I would imagine a fair bit of equity in their principal place residence, but they're just locked up. They can't extract it because of serviceability requirements.
Yeah.
Yeah. It's such a common thing right now. And how long it's got to be like that? Look, it's just getting back to normal. Mm. 0.1% interest rates were not normal and will never be normal. We're in a normalized interest rate environment right now. So I think for a lot of people, it's about recalibrating expectations around investing in property and the speed at which they can accumulate properties. And I know that's frustrating for a lot of people, and it annoys them and pisses them off. But that's the nature of the market we're in right now. That's the nature of the fact that we do have, I spoke to about it beforehand, the regulatory environment around policing our banks means that when there is headwinds like we are facing right now, largely the banks are pretty strong. I can't see a run on Australian banks at any point soon, but there are ways around it. So what's the name of the couple, Sandeep and Veena? What do they do for a living, Eva?
They're both employed by the government as they're doing like office admin job. They've been there forever. So they've, in a good way, have been paid super on a regular basis for many years. So to me, that was, I guess, a flag to realize that they probably have a healthy super balance and probably haven't really looked at it for a while. So, yeah, that was definitely something that triggered to...
How much did they have? How much super between them did they have? Do you know?
So at the time, we didn't know. They didn't know either. It's not something that they checked, I guess. Yeah. But it turned out they had close to $200,000 in there.
Yeah, okay. And there's requirements around sort of how much super you need in order to set up a self-managed super fund. It's a little bit grey because sometimes it's just not practical. It used to be $200,000, right?
Used to be $200,000, and now there's lenders that don't have any requirement at all. Yeah.
So it's changed a lot. And the practicality of running your own super, it means you're running your own investment fund, right? So there's a certain degree of sophistication needed around it. Now, a lot of that can be sort of buttressed by a really good accountant or financial planner, right? But there is certain requirements about running a super fund. You need to get it audited. The money that you need sort of be very prudent in how money is transacted in and out of the super fund because it is audited. It is an investment vehicle. There is penalties if you don't do it appropriately. But the old language used to be a couple of $100,000 made it worthwhile to set up your own super fund. If I think back sort of 7-8 years ago, I'll say it as it is, there was a lot of sharks and charlatans operating around self-managed super with investment opportunities for off-the-plan apartments. And a lot of people subscribed into it, probably inappropriately taking out well, setting up super funds and buying the wrong assets within it. I know there's still a legacy around that. So it is policed. It is a big asset class. There's a lot of assets sitting inside of it. And we now know that the government is taking a look at how large the value of super assets should be for individual Australians to try and normalise a little bit and democratise it. So there's a lot going on, but a bit outside of the scope of this chat. So you've got Sandeep and Veena. How much they make a year? About 165 as a family income. That's pretty. That's probably above average, right?
Yeah, just above the average. Yeah, I guess.
Yeah.
Good income, just not enough to keep investing outside of super. The sad actually reality of it is even to refinance what they had, they couldn't even support the debt they had. And that's unfortunately today's market is not only you can't buy anymore, but you can't even technically have what you have.
Yeah, and that's this idea of mortgage prison that I've been chatting about, and you've sort of been hearing about it elsewhere, which is, let's be clear, if you don't meet the serviceability requirements for your current mortgage, it doesn't mean that the bank's going to come and say, sell your house, we're going to rip it up, right? If you can service your mortgage and you don't default on it, everything is okay. Don't worry about it. It's sweet. And you'll find quite a lot of people are in that particular bucket because serviceability requirements is now you're pretty much, assessed at about 10%, which is sort of 6.5-ish, 7% for your variable rate without discounts, plus 3% buffer. So for a lot of people, they don't meet the serviceability thresholds as they're in right now. What that means is that they can't refinance a mortgage with another lender because they won't meet their serviceability thresholds, which means you're stuck with the lender that you've got. And it's very hard to negotiate from a position of power if they know that you can't move that mortgage elsewhere. So this is where people are stuck at the moment. It's going to be like this for some period of time. There's a number of ways you can change that. You can reduce your debt levels, and you do that by selling off an asset. Potentially you might, get a big bonus at work, or you might get an inheritance, all this sort of stuff, right? And this is what you need to be chatting to your broker about. But a lot of people are now stuck with the lender that they've got. They can continue to service their debt. It's all okay. One of the biggest issue is, and everyone's chatting about, is this interest rate cliff. So a lot of people aren't going to meet the serviceability thresholds to move their mortgage. Their mortgage isn't portable when they come off these fixed rate mortgages onto variable. And that's the big concern at the moment within the RBA. It's a big concern within banks and the wider sort of economic environment in Australia about what is going to be the holistic impact of people coming off these low rates onto variable rates and potential impacts on the property market outside the scope of this. But the point being, Eva, that you can actually still invest inside of your self-managed super fund if you have that deposit sitting in there by way of assets in your super fund, and your lending is isolated and viewed only within the realms of the self-managed super fund itself. So that might be a bit of a newsflash or a eureka moment for a lot of our listeners going, I didn't know that. I thought it sort of included everything else. I had to provide statements and stuff. No, your service, it's non-recourse lending, right? The asset is pegged against itself inside of the super fund and your ability to contribute to that through your superannuation contributions every month, and also the income that's generated from the property that sits inside of it. So let's have a chat about what you did, Eva. We'll just go to a quick break beforehand. Stay with us, everyone. Back in a moment.
Are you looking to create passive income through property? Simon Liu from Housefinder has achieved over $700,000 per annum in passive income by only buying genuinely off-market, below market value and cash flow positive houses within major capital cities. For the past 7 years after quitting his day job, he has been helping others achieve similar goals to reach financial freedom. On average, his clients achieve $80,000 plus equity extractions from the houses they find, all within 6 months of buying. Visit housefinder.com.au to find out more.
Welcome back. Phil Tarrant, host of the Smart Property Investment Show, with Eva Loazance from Finney Mortgages. Now, Eva, was this an easy process to get them sort of investing in self-managed super fund? I would have started with them having to speak. You mentioned their accountant and stuff to set up a fund. How long did that take? And could you start the sort of finance bit before that was done?
Yeah, so obviously they didn't even know about SMSF before we spoke. So to me, it was everyone needs to anyway. They had to meet with the financial planner and the accountant just to check it was, the solution for them. And both their accountant and financial planner supported the purchase through SMSF. So I think there's a wrong idea there that you need the SMSF set up before you get a pre-approval, which sort of stops people a little bit because it costs obviously quite a bit to set up an SMSF, and people are a bit scared to pay all these fees and then being told no, you can't invest in your SMSF. But it's actually not true. You can go and see a broker, do a pre-approval as if you already had your SMSF, and see if you can actually invest into it in terms of, is it working, the servicing capacity-wise. So we did check that, and then I just, referred them to seeing their accountants, financial planner. They came back to me, yeah, it's working. So then we actually did a full pre-approval application, and based on what they had, so that $180,000, just a bit more in super. They were looking to buy a property for up to $450,000. They get 10% super contribution each year, each of them. We're looking at a yield around 5%. Everything worked, tick, tick, tick. And I said to them, maybe it's because it's in super, probably a good idea to buy through a buyer's agent to really have a property that will grow and provide you with good rental yield. And they did just that. So that was a good start for them. And then they were just thrilled that they could keep going. Yeah.
So quite a few moving parts there, Eva. So you couldn't start, and so you could have a preliminary discussions about, hey, here's the concept, and you could stress test it. Yeah, it will probably work, but they had to go away and get their self-managed super fund set up before you could do anything formal, right? You can't do applications and stuff until there is.
You can do pre-approval applications without it.
Oh, can you? So you can do. So these two things can move. Concurrently without sort of going, I've got to set that, because sometimes it takes forever to set up it shouldn't take forever to set up because it's really just some paperwork and stuff, but the headache of doing it and then trying to work out all the bank stuff. And by the way, it's, if you haven't got a super fund, self-managed super fund, and you go about doing it, you're going to sit there and just go, what's all this custodian stuff and what, there's all different parts of it. And you sort of go, this sounds unnecessary. If you're buying property inside of it, there's another layer of complication rather than sort of buying stocks and shares inside or other asset classes inside your super fund. So you probably just going to go, I don't get it. This is all confusing. So make sure your accountant articulates it, spells it out to you. I got mine to draw it out. I'm a very visual sort of person, saying, okay, how's it all work? What does what? Who talks to who? Blah, 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 blah. So do that, right? Do that. But what you're saying is that, if you go down that pathway, you can start on the mortgage side of things pretty quickly. Now, what sort of deposit do you need buying residential property inside of a super fund?
Yeah, so that's the other, I think, thing people don't realize. And it used to be you needed 30% as a deposit. Used to be a very clear cut there. And then it grew to 80%. And recently we've seen lenders saying you can borrow up to 90% within super.
Really, 90% now for resi. Commercial still sort of around still 70% LVR, right? Yeah. Who look, I don't want to give them any free coverage, but what sort of lenders are doing 10% deposits in self-managed super fund?
So we have at the moment Better Mortgage Management, which are
BMM.
BMM, looking to a mortgage manager, so not directly a lender, but they have access to really good products. Blue Bay Home Loans as well is doing really good things with.
Who's that? Sorry,
Blue Bay.
Blue Bay. Okay, cool. So this is sort of like your second tier and mutual lenders or regional lenders and mortgage managers operating a little bit more. And so, like, I think St. George is still doing SMSF. No,
unfortunately, none of the big banks have done SMSF for a while now.
Yeah, and you see this a lot, and this sort of ebbs and flows. But they're all very good lenders sitting outside of those major banks. So maybe you just got to sort of open your mindset around some of the lending. And typically, what happens, and I won't get too detailed about this, but it's a podcast in its own right how it all works. But typically, outside of the major banks and second tier lenders, and by second tier lenders, I would refer to Bank West and Suncorp and AMP. They're all big household names in Australia, all very good financial institutions. There's other people that operate in and around mortgages, and this is one of the great things that mortgage brokers do, is that they just don't look at the major banks. They look at all lenders in the market to get you the right loan or the right product for what you're trying to do. There's mortgage managers out there and non-bank lenders. So you're going to sit there and go, well, what's a non-bank lender? What's a mortgage manager? Essentially what they do, they get their money from some major financial institution and they make their own mortgages. So the money comes from some large financial institution in a warehouse facility or some other mechanism. And what they do is that they package it up and they lend it out as mortgages. So that's what a mortgage manager does. So the money's coming from someone big anyway. And a lot of these lenders have been around for a long time. So if you're going to go into SMSF products, whether it's commercial or residential, don't expect to see the major banks there. Expect to see some lenders that you've probably never heard of. But that's okay, isn't it, Eva?
Yeah, well, look, there's no options. Westpac and NZ, and they're out of SMSF. So you'd find names you might know still, like La Trobe, First Mac, they do SMSF. There's still a few that people might have heard of, and they're still really good. They're just sometimes not the cheapest, or they're not going to go up to 90% LVR, but they're still good options. And it's becoming also, on another side, really cheap now to move from a lender to another within SMSF. So refinancing is becoming a lot more possible, I guess, within SMSF than it used to be when the majors were running it. That was really expensive.
So your mortgage is a lot more portable these days in SMSF. Yeah. Okay. Can you give me some sense? And look, again, this is just a really generic conversation. We're not sort of pegging this to anything at all, because someone might be listening to this in 2 months' time and the rates have changed. But can you give me a sense for those people who are going out to SMSF lending in residential, or those people with a residential property inside SMSF, what's the spread on sort of interest rates at the moment?
I would start depending on LVR, depending if you do interest only or PNI, if you're on an offset or not. Let's say between 6.5 to 7 plus.
Okay, so a little bit more expensive than outside of super, but compared to what those numbers were sort of 3-4 years ago, it's still pretty competitive. And it's the great thing about buying inside of your self-managed super fund, and traditionally most of it was 70%, 80%. Not only does the rent you receive from your super fund, from the property sitting inside a super fund, help service the debt, you also have your contributions every single month paid by employer that go into the same pot as well. So this is a good thing, because largely most people should be, hopefully, cash flow positive when it comes to these two sort of income generating things that you have. Now, ideally, you want the property stand on its own 2 feet in terms of a cash flow point of view. And again, this is very general when it comes to the rent should be paying, hopefully, the mortgage. And if you've gone at 70% LVR, often that will be the case. You have a good fallback that your contributions can help sustain the mortgage if it's negatively geared. But this is one of the advantages around self-managed super funds. But speak to your mortgage broker about it. Eva and her team, happy to chat about it at Finny Mortgages, and also ask your accountant as well. You got to run the numbers. It's, have some fun with it. Once you understand it, you'll probably be attracted to it. Now, so did you do this whole consultation and financing just over Zoom? Like how onerous was the process? Yeah,
it was all through Zoom. They're both working in offices and didn't want take the time to come in the office during the week, and I guess take time off. So it was all through Zoom, and it was all fun. I actually also met the accountant through Zoom just to confirm numbers, and it all worked. That everything was working just as they needed to be. So I think there's a stigma around SMSF that it's complicated, and it can be, but it can actually be done quite easily, especially the loans now are not so complicated to get started. Obviously, you need a broker that understands it, and a lot of brokers don't even touch SMSF, but it can be done quite easily once you've decided to go ahead. Yeah.
Okay, cool. So let's chat about what you did and the options, and whether or not you had to shuffle any of their other mortgages. So we'll just go to another quick break. Stay with us. Back in a moment.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.
Welcome back. It's Phil Tarrant from Smart Property Investment with Eva Loazons from Finny Mortgages. You find these guys at finny.com.au if you're looking to do some SMSF stuff. But what was the plan, Stan?
So we got a pre-approval up to $450,000. As you said, purely backed by the super contribution and a yield of 5%. So that all tick the box servicing wise. Most people, if you are a couple both working and you've got, let's say, 150K in your super, most of the time that will work, because everything you have outside of super is not taken into consideration. So your mortgage, your credit card, your car loan, we don't look at that. So your SMSF will stand alone there, almost like a third person working for you. So we got a pre-approval. They engaged a buyer's agent to find a property. It took almost 2 months, I think, to find a property, but pre-approval lasts 3 months anyway, so it was all within timeline. And they did buy a property in Perth for $430,000. So just under their pre-approval limit. So that was all easy to get approved at the end. So very good deal as well. Yeah.
Yeah. So do they tinker with their current mortgages at all? Because often I know when people go down this pathway, they also look at, still preparing in the background about how do they invest outside of superannuation, even though this was the solution for today. Yeah. How do they prepare for tomorrow?
Yeah. So we obviously had to look at what they had at the time. So in planning for more investing in the future. So we found out that, obviously they've got 2 teens at home that are close to being 18. So that's something people don't really think about. But technically, once they're 18, they're not your dependent anymore, and that will help your servicing capacity. We found that they're paying principal and interest on both their loans. So I suggested to them that maybe they should switch to interest only on the investment loan, so they could actually make extra repayments on their home loan and pay it down quicker, because that is what really affects the servicing. So that's what they're going to look at doing. They have a lot of savings as well, just sitting in an account, doing nothing.
Well, not offsetting, no offsets, no.
No,
that's just bonkers. If you don't have an offset account, you've got savings. Like, let me give you a hot tip. If you might get 4% on a savings account these days, which is much better than what it was 12 months ago. But I tell you, you're going to get a lot more than 4% if you've got an offsetting part of your mortgage interest. So if you're going to do one thing, do that.
Yep. So we did create an offset account for them that will definitely help them save on interest as well. And then
how hard is it, Eva? Sorry, how hard is it if you don't have an offset account against your mortgage, whether it's investment property or principal place of residence? Some products don't allow you to have an offset. Like these are the sort of low rate, low frills type stuff. But can you normally retrofit an offset into a mortgage?
You can switch product. That shouldn't be a whole application. That should be actually quite easy to do. If for whatever reason there's no offset available at all to your product, you can still put the money in redraw. That's better than having sitting it nowhere.
So even on these no frills accounts, you can often do a redraw. Okay. Yeah. So redraws, a lot of people get confused between offsets and redraws. And redraws is where you actually put the money onto the loan, but you can actually pull it back out. Whereas an offset is that it's an account that sits in parallel to your mortgage, and the bank just considers whatever's sitting in there as reducing the debt level, and therefore you pay less interest on it. So redraws can take longer to get your money back. They're pretty good these days, whereas offsets, it's really liquid. And I know most property investors who have cash have it parked in offsets. I know some people who have their whole portfolio offset who have done very well. So that's a really good tip. So the point was, and this is not tax advice, I just want to explain this for our listeners, just if they didn't pick it up. So on your principal place of residence, there's a lot of advantages investing in property in your principal place of residence because, and I know a lot of people use this as a strategy as investment, is that you don't pay capital gains tax when you sell your principal place of residence. So what a lot of people do is that they get a principal place of residence, they might do a renovation, let it go up in value, whatever they do, they sell it, they buy another principal place of residence, and they realize cash through that process, and sometimes they park it into investment properties, or they buy a better principal place of residence. So you don't get the capital gains tax on it. However, the interest you pay on your principal place of residence isn't tax deductible. So you get no taxation benefits from it. The flip side of that is in your investment property, the mortgage, what you pay in your repayments is a tax deduction, and your accountant can sort of wash all that through and see if there's any tax effectiveness around it. So paying off the principal component of your investment property, your point, Eva, you're much better pumping more money into the non-deductible debt inside of your principal place of residence by driving that down, increases your serviceability thresholds in other areas. So that's a smart solution. And it's not to move from principal interest to interest only. That would be a new application, though, in your investment property. Is that correct?
Most lenders these days will ask you to do a full application, but some of them still don't. A few of them.
Is there? Because when I was having a chat with Mark Burris the other day, we said, look, here is a piece of mortgage innovation. Go back to the days where you could just pull up your bank and say, I don't want to do P&I anymore. I want to do interest only. And they used to go, yeah, sure, no worries. Done. It'll be effective in the next cycle or the next whatever. Now you've got to do a whole new application. So I reckon that's one thing if they want to increase, there's two parts of it. Number one, people who are are under some sort of financial stress as a result of these raising interest environments, and it might be temporary, allow them to move interest only, get more cash flow. But on the other side, for those people who are looking for capitalising on this mortgage market, this current real estate market, and they want an enabler to increase their serviceability, moving to interest only. So, in investment properties, I think it should be looked at. I wouldn't say they should apply it into owner-occupiers, allowing people to move from principal and interest to interest only on their own principal place of residence. But anyway, I'm not a policy maker. I'm just a commentator around real estate mortgages either. But so that's not my problem. So the options for them.
Yeah, they did. They actually are with that one lender that will allow you to go on interest only without an application. So that was
okay.
That was good. That was really good.
That's handy. See, only your mortgage broker is going to work that out, right?
Yeah. So that was really good. So they switched to interest only on the investment. So that was good because they didn't know the difference. They just, were paying down the debt as if it was the same on our investment. Doesn't matter. We're paying it down. It's to them it made no difference. But if we review the loan in 2 or 3 years, what they did, last month or so, will make a huge difference in 3 years when the home loan is maybe a few $100,000 lower than it is today.
So Eva's team's currently working through a whole bunch of my properties or the Smart Property Investment Show's properties to move them from P&I to interest only. So I've got to catch up with your team on that as well. It just reminds me, just to increase the service, or not the serviceability, but the cash flow on those properties. So just paying the interest component rather than the principal components, because I guess we're sort of viewing it, as I mentioned, that second part of things, and that is how do we capitalise on this market by reducing cash flow to enable the purchase of more properties. So watch your space. We're going to do a big update on it. That's cool. So clients happy?
I'm very happy about their property. They're having a plan for the future to buy another one in a few years. They learned about SMSF and actually got a lot of referral from them for people that they work with that just want to do the same thing. So it's becoming very popular to invest through super.
Yeah, go and check it out. Speak to your accountant, speak to your mortgage broker. Let's just summarise, Eva, what most people get wrong around SMSF lending.
Yeah, so there's a lot. There's a lot. And I think it's because the space has changed a lot in the last few years. As we mentioned earlier, you don't need 30% anymore to buy a property in super. 10% will get you there. The rates might be a little bit higher, but it will get you there. 80% is just good as well. That's I guess the average now. That's what you'd see. People think as well that you can't have an offset in super. You can. So if you've got cash sitting there that you don't really want to invest in shares or other things, you can have.
Are you sure about that? Because I still, for some reason, I've got it in my head that you can't offset a loan inside, because I keep a cash balance in my super fund, and at the moment I don't want to put it in shares, so I sit there frustrated that's not doing anything. But so only some lenders allow that. Some lenders. Which lenders? Can you tell me one or two? Or do I got to call you up?
The one I mentioned earlier. The one I mentioned earlier can do that. Yeah, Blueberry, I know that.
You put that into the context, right? Like you said, rates are sort of 6 to 7%. That means if you're offsetting debt inside of your super fund with cash, you're getting 6 to 7% on it, and that's handy, right? That's not locked up inside of some shares, which may be going up or down, or some other sort of investment vehicle, ETF or bonds or whatever else you got it in, which is a little bit harder. It's a little bit less liquid to transact in. That's not a bad return on your money at the moment, to be fair. So I might look at refinancing. I'm sure maybe the lender currently with my SMSF won't be happy about that, but no, they're okay. I'm going to actually speak to you offline about that to see whether or not my lender, it's commercial, so it might be different. Anyway, what else is sort of the myths in SMSF that we can sort of debunk?
Yeah, we have people that think they can only have principal and interest on SMSF. So I think that used to be, I guess, the norm, but it's not anymore. You can have interest only, no problem. I also have got a few clients that seem to think they can only buy one property through SMSF. So I guess it's true that you can't get cash out from your property. You can't, refinance and get equity out or these sort of things. But if your balance is growing and you bought a property 5 years ago and you've got 100K there again, you can definitely buy a second property through super.
That's a good point, because I'm having exactly the same conversation now, and this is around sort of planning with your accountant or your financial planning. So you got to work out there is limitations investing inside of your self-managed super fund. You can't add value to assets inside of your self-managed super fund. You can do repairs and maintenance and stuff, but you can't proactively change the nature of what they're doing. There's very, very sort of rules around it. You got to work out, how do you realize the investments inside of your self-managed super fund? Because at the back end of it, if you start liquidating to free up cash to provide for a lifestyle, whatever it is, again, there's tax consequences around it. So you've got to explore all these different things. It's just not like, hey, I can buy a house or buy a property in my self-managed super fund. You've got to think about the ramifications at the back end and get some really good advice around it. But you can have more than one property.
Yeah, that's definitely fine. As we mentioned before, in case you're not too sure if you should set it up or not, you can get a pre-approval before you go and set up your SMSF. So all we do, we just put to be advised trust, to be advised trustee, and then we send it to the bank and they assess it as if it was set up, even if it's not. They just look at your super contribution, projected yield, and that's all. That's all we need to.
So you need to take an asset to them, though, that you want to buy when you do the application, because they assess the asset themselves, or could it just be, I'm thinking of buying this sort of thing?
Yeah. We just do like we did with Sandeep and Vina. They were looking at a $450,000 property based on the accountant's recommendation. We used 5% yield and then 10% of the income, and we just worked with that.
Okay. And it's a little bit easier doing inside of Resi because there are so many like-for-like comparisons and predictability around sort of yields and rental returns and all that sort of stuff. And the point you made, Eva, which is a good one, is the portability of your mortgage inside of a self-managed fund, because normally there's fees, setup fees to get into it, but there's a lot of competition around this right now. So lenders actually want SMSF. Those lenders who operate inside of SMSF actually want SMSF business.
Yep. So it used to be tempting. I've done some refinance of SMSF in the past where it costed people $5,000 just to move. These days, you find lenders that have zero fees. You move for zero. It doesn't actually cost you anything. There's one lender at the moment that actually has a policy that if the rate is cheaper and your repayments are cheaper than what you are now, approved, sorted. So it can be quite easy. Yeah.
It's once you're going through it, it's particularly if you've got a lot of properties outside of super, it gets complicated the more you get. Whereas it's a little bit simpler once you are set up inside of the SMSF. That said, there is still a lot of compliance regime around it as well. Eva, that's super informative. Thanks for sort of explaining that. What's next, do you think? I know we're sort of getting emails in, but have you got any ideas around our next sort of scenario with mortgages? Because it's all about mortgages at the moment.
Yeah, I'd like to bring on Sarah, actually, that works with us. She used to be a private banker, and I think it would be really good insight for clients to understand the difference and when they should use one or the other. What better suited for each person. So she's seen both sides. She's been both brokers and private lender, so she might have good insight there.
Yeah, I think that's cool because I think property investors, not everyone, but some at a point in time, will start sort of gaining the attraction of sort of private banks once they get to a particular sort of threshold in terms of asset value. And there's this sort of idea that once you move into a private banking environment, that it cuts the broker out. But a lot of the really good private banks actually work hand in glove with mortgage brokers, and there's a number of them I can think about now. So I think that'll be a good chat.
I think so.
Be a good chat.
I'm looking forward to it. Yeah.
Nice. So 3 takeaways for me, Eva. Number one, think differently about self-managed super. It might be an enabler if people have met serviceability thresholds outside of super. Number 2, you're looking for more mortgage brokers. So you're just looking for one or looking for many? It just depends if you can find. What do you like, mortgage brokers that used to be private bankers come and join you? Is that the perfect? They've got to deal with guys like me, right? Which is not easy. And you've been a bit cagey with some of the lenders there. I imagine you just want people to inquire to find out more about them. But how do they do that?
Yeah, they can give us a call or put your details into finny.com.au with your number, and then we'll set up an appointment to discuss.
Okay, cool. Eva Loazons, thanks for your time today. Always enjoy it. We'll see you again in a couple of weeks' time. Thanks for tuning in, everyone. Remember, smartpropertyinvestment.com.au, social media, Smart Property HQ. And keep your eye out for some pretty interesting stuff about to be released. Can't say too much right now, but imagine you'll see a lot of headlines all over the place with what we're about to do. So watch this space. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.